For 2 years, the world waited for BRICS to launch a currency, a gold-backed challenger to the dollar, a monetary revolution. It never came. At the Kazan Summit in October 2024, the official 33-page declaration, 134 policy points, did not mention a unified BRICS currency a single time. Everyone assumed they failed. They did not fail. They built something harder to see, harder to stop, and harder to sanction. A decentralized network of bilateral swap agreements, parallel payment systems, and cross-border settlement infrastructure designed to bypass the dollar without replacing it. Today, 99% of the $245 billion in annual Russia-China trade settles in local currencies, entirely outside Western oversight. 30% of all Chinese global trade now settles in renminbi. Central banks bought 863 tons of gold in 2025, and the dollar's share of global reserves has fallen from 72% to 56.77% in 24 years. They did not build a currency. They built the plumbing to make one unnecessary. The currency that never came. The expectation was real. At the 2023 Johannesburg Summit, Xi Jinping called on BRICS to accelerate reform of the international financial and monetary systems. Lula da Silva pushed explicitly for a common reserve currency to bypass US financial architecture. BRICS controlled 43.6% of global oil production and 36% of natural gas. The combined GDP of the bloc at purchasing power parity reached $75.6 trillion, surpassing the G7's $56.6 trillion. A currency seemed inevitable. Then, Donald Trump threatened 100% tariffs on any BRICS nation that pursued it. Brazil dropped the common currency from its 2025 presidency agenda. Putin confirmed that a unified BRICS currency was no longer an immediate objective. The bloc lacked the unified central banking apparatus required to manage one. The Eurozone took over a decade to build and still suffers from fiscal divergence among 20 member states. 11 sovereign nations with vastly different economies were never going to surrender monetary policy to a shared central bank. But the retreat from a currency was not a retreat from de-dollarization. It was a strategic pivot. Instead of one fragile institution, they built 4 independent systems. The 4 platforms. The first is CIPS, the cross-border interbank payment system, launched by the People's Bank of China in 2015. In 2024, CIPS processed 8.216 million transactions, a 24.25% year-over-year increase, worth 175.49 trillion yuan, approximately $24.47 trillion. That is a 42.6% surge in transaction value in a single year. Daily throughput averages 30,500 transactions worth $90.95 billion. As of mid-2025, 1,690 financial institutions across 121 countries are connected to the network. The second is SPFS, Russia's SWIFT alternative, operational since 2014. By early 2026, 177 foreign financial institutions across 24 countries had connected to the network. The US Treasury's OFAC issued a formal compliance alert in November 2024, warning that any foreign institution joining SPFS would be flagged for secondary sanctions. They joined anyway. The third is mBridge, a multi-central bank digital currency platform originally backed by the Bank for International Settlements. 5 central banks participate: China, Hong Kong, Thailand, UAE, and Saudi Arabia. By early 2026, mBridge had processed over 4,000 live cross-border transactions, totaling $55.49 billion. A 2,500-fold volume increase since inception. Cross-border settlements clear within seconds at roughly half the cost of traditional SWIFT routing. China's digital yuan comprises 95% of all settlement volume. In late 2024, the BIS quietly withdrew from the project, leaving China and its partners to expand independently. The fourth is BrixPay, a decentralized messaging system with no central hub, no single owner, and no mandatory transaction fees. Each participant manages its own local node, making the network resistant to external disruption. Processing capacity is rated at 20,000 messages per second. China fully backed the initiative in October 2024. Underpinning all 4 platforms, over 40 active bilateral currency swap lines holding an estimated $600 billion in non-dollar liquidity, anchored by the People's Bank of China. The largest single agreement, a 400 billion yuan facility with South Korea, is worth $56.44 billion alone. The de-dollarization data. The numbers tell the story in three layers. First, reserves. The dollar's share of global allocated reserves fell from 72% in 2001 to 56.77% by Q4 2025, according to the IMF's COFR data. The decline is not a cliff, it is a slope, but 15 percentage points of structural erosion over 24 years represents trillions of dollars redirected into euros, yuan, gold, and other currencies. Second, payments. The dollar still dominates SWIFT at 49.68% of international payments by value as of January 2026. The yuan holds just 3.13%. But in trade finance specifically, the yuan has reached 8.48%, second only to the dollar's 80%. And 30% of China's total global goods trade now settles in renminbi, bypassing dollar invoicing entirely. Third, bilateral corridors. Russia-China trade hit $245 billion in 2024, with over 99% settled in rubles and yuan. India and Russia executed $68.7 billion in bilateral trade during 2024 to 2025, with up to 80% conducted via a rupee-ruble settlement mechanism. Indian imports of Russian crude peaked at 1.8 million barrels per day. In the Gulf, Saudi Arabia signed a 50 billion yuan swap agreement with China in November 2023. The UAE executed its first renminbi-settled LNG contract. By the end of 2023, non-dollar oil transactions accounted for an estimated 20% of all global oil trades, an all-time record. And central banks are buying gold at historically unprecedented rates. In 2025, global central banks purchased 863 tons, the fourth consecutive year of elevated acquisition. Poland led with 102 tons. China added 27 tons, pushing its reserves to 2,306 tons. China added 27 tons, pushing its reserves to 2,306 tons. Brazil accumulated 43 tons in just 3 months. Gold purchases represented 17.2% of total global gold demand. The economic weight behind the network. This infrastructure is not being built by marginal economies. BRICS now comprises 11 full member states with 10 partner-tier nations and over 50 countries expressing interest in joining. The bloc represents 48.5% of the world's population. At purchasing power parity, BRICS GDP reached $75.6 trillion in 2024 versus the G7's $56.6 trillion. BRICS growth is projected at 3.8% in 2025, anchored by India at 6.6% and China at 4.8%. The G7 will average 1.0%. In trade, BRICS exported $5.9 trillion in goods in 2024, 24.6 to 28% of world exports, closing on the G7's 32% share. China alone generated 64% of those exports at $3.59 trillion. In manufacturing, China produces 27.7% of global output, $4.66 trillion. Add India's 2.91%, and 2 BRICS members control over 30.6% of planetary manufacturing capacity. Why this is harder to stop than a currency? The entire US sanctions architecture depends on 2 things: visibility into the SWIFT network and the requirement that dollar-denominated transactions clear through American correspondent banks. The 4 BRICS platforms eliminate both. Transactions route natively in local currencies through encrypted, closed-loop systems. The US Treasury cannot see them, cannot freeze them, and cannot interdict them. The scale of what is already invisible is staggering. Over 99% of $245 billion in Russia-China trade bypassed Western oversight in 2024. India imported up to 2.8 million barrels per day of Russian crude through rupee-ruble channels that never touch dollar clearing. A vast shadow fleet of tankers delivers sanctioned oil from Iran and Russia into Chinese ports, where independent refineries process it with origins knowingly misreported in customs data. Payments flow through regional Chinese banks via shell companies routed through Hong Kong. OFAC has responded with warnings and secondary sanctions threats, but the architecture is decentralized. There is no single choke point to target. Sanctioning 11 deeply integrated economies that collectively represent 41% of global GDP and 43.6% of oil production would inflict as much damage on the enforcer as the target. The dollar's structural defense. The dollar retains enormous structural advantages. American capital markets are the deepest and most liquid in the world. The Treasury market provides an unmatched safe asset haven. US rule of law ensures transparent governance for foreign capital, and the network effects are deeply entrenched. 89% of global exchange rate turnover and roughly 80% of trade finance are still denominated in dollars. The switching costs for developing nations are massive, but these advantages carry a cost. Michael Pettis of Peking University argues that dollar dominance forces the United States to absorb the savings and demand imbalances of the entire world, running perpetual trade and fiscal deficits to supply global liquidity. The U.S. spent $906 billion on debt service in 2024 alone, and Treasury Secretary Yellen herself acknowledged in June 2024 that the dollar's reserve share should be expected to gradually decline as countries naturally diversify. The political defense has been blunt. Trump's 100% tariff threat successfully killed the unified currency concept. But analysts from the Atlantic Council and Peterson Institute warn that weaponizing tariffs and sanctions actually increases the perceived risk of dollar dependence, perversely accelerating the quiet build-out of the four parallel payment systems as a matter of sovereign economic security. The tipping points. Goldman Sachs projects that the U.S. share of global equity market capitalization will fall from 42% in 2022 to 35% by 2030 and 27% by 2050. Emerging markets will rise from 27% to 47% over the same period. The Boston Consulting Group forecasts China BRICS bilateral trade growing at 5.5% annually, with China surpassing the U.S. as the primary trade partner for the entire global South. The macroeconomic consequences for the United States are concrete. Congressional Budget Office and NBER models show that a $100 billion reduction in foreign purchases of U.S. assets raises Treasury yields by over 100 basis points. A 1% structural shift away from dollar assets by China alone would immediately add 24.4 basis points to Treasury yields, tightening mortgages, auto loans, and credit across the American economy. The critical trigger remains energy. If Saudi Arabia begins broadly pricing oil in Yuan, market models indicate 10 to 15% of total global dollar holdings could be reduced over 3 to 5 years. As Berkeley economist Barry Eichengreen summarized, de-dollarization is proceeding through cumulative institutional change, not a single rupture. The dollar's share of global reserves, down from 72 to 56.77%. CIPS processing $24.47 trillion in 2024 across 121 countries. mBridge clearing $55.49 billion with 2,500-fold growth. Russia-China trade, $245 billion, 99% in local currencies. Central banks buying 863 tons of gold, and 4 independent payment platforms designed to make the dollar optional for 41% of the global economy. BRICS did not fail to build a currency. They realized a currency was the wrong weapon. A single currency can be attacked, sanctioned, devalued, and politically fractured. A decentralized network of bilateral swap lines, parallel messaging systems, and multi-CBDC platforms is none of those things. It is invisible, redundant, and already processing trillions. Zoltan Pozsar, formerly of Credit Suisse, put it precisely. When you look at what China and BRICS have been building in the totality of things, over a 10-year perspective, it adds up to quite something. The question is not whether the dollar will lose its throne. The question is whether anyone in Washington noticed that the throne is now optional.